If you're a freelancer or self-employed, you probably know you're supposed to pay estimated taxes 4 times a year. But here's what most people don't know. There's a specific formula the IRS uses that can protect you from underpayment penalties, even if you don't pay the exact amount you owe. It's called the Safe Harbor Rule, and if you understand how to use it, you can avoid penalties while keeping more cash in your business during the year. I'm going to show you exactly how to calculate your 2026 estimated tax payments using Safe Harbor rules, when to pay them, and which payment method saves you the most time and hassle. Let's get into it. First, let's confirm you actually need to pay estimated taxes. The IRS rule is simple. If you expect to owe at least $1,000 in tax when you file your return, after subtracting withholding and refundable credits, you need to make estimated payments. For most freelancers, this kicks in pretty quickly. If you're making net self-employment income of around $6,000 or more for the year, you're hitting that $1,000 threshold because of self-employment tax alone. That's the 15.3% you pay for Social Security and Medicare. If you have a W-2 job and freelance on the side, your W-2 withholding counts toward this requirement. So if your employer withholds enough to cover your total tax liability, including your side income, you might not need estimated payments. But most full-time freelancers and self-employed people, you're on the hook for quarterly payments. Here are the exact due dates for 2026 estimated tax payments. First quarter is April 15th, 2026. Second quarter is June 16th, 2026. That's adjusted because June 15th falls on a Sunday. Third quarter is September 15th, 2026. And fourth quarter is January 15th, 2027. Notice that the quarters are not equal. The second period is only 2 months, April and May. The third period is 3 months. And the fourth period is 4 months if you're paying in January, instead of filing your return by January 31st. If you file your tax return by January 31st and pay your balance in full, you don't need to make that fourth quarter payment. But most people can't file that early, so, you're making the January 15 payment. Here's where it gets interesting. The IRS gives you 3 ways to avoid underpayment penalties, and you only need to meet one of them. These are called Safe Harbor rules. Option 1. Pay 90% of your current year tax. If you pay at least 90% of what you'll actually owe for 2026, you're protected from penalties. The problem? You don't know what you'll owe for 2026 until the year is over. So this is hard to use unless your income is very predictable. Option 2. Pay 100% of your prior year tax. This is the most common safe harbor for freelancers. Whatever your total tax was on line 24 of your 2025 Form 1040, that's your safe harbor number. Divide it by 4, and that's your quarterly payment. Even if you make way more money in 2026 and owe way more tax, you will not get hit with underpayment penalties as long as you paid 100% of last year's tax. Option 3. Pay 110% of your prior year tax, but only if your 2025 adjusted gross income was over $150,000 or over $75,000 if you're married filing separately. If you're a high earner, you need to pay 110% to get safe harbor protection. So if you owed $20,000 in tax for 2025, you'd need to pay $22,000 in estimated payments for 2026 to be protected. Here's the critical thing most people misunderstand. Safe harbor only protects you from the underpayment penalty. It does not mean you won't owe more when you file. If you had $20,000 tax in 2025, paid $20,000 in estimated payments for 2026, but you actually owe $30,000 for 2026, you'll owe the $10,000 difference when you file. But you won't owe a penalty on that $10,000. Let me show you the calculation. Go to your 2025 tax return, the one you're filing by April 15th, 2026. Look at Form 1040, line 24. That's your total tax. Not your refund or balance due, your total tax before payments and credits. Let's say it's $15,000. Check your 2025 Form 1040, line 11. That's your adjusted gross income. Is it over $150,000? If no, your safe harbor number is $15,000. If yes, your safe harbor number is 16,500. That's 110%. Divide by 4. If your safe harbor is $15,000, you're paying $3,750 per quarter. If it's $16,500, you're paying $4,120 per quarter. That's it. Make those 4 payments by the due dates, and you're protected from penalties, no matter what your 2026 income turns out to be. Now, if your income is really irregular, like you make 80% of your annual income in the last 3 months of the year, the safe harbor method might force you to pay too much too early. In that case, there's something called the annualized income installment method. This lets you calculate each quarter's payment based on your actual income through that date, not your annual projection. If you only made $5,000 in the first quarter, but $60,000 in the fourth quarter, you can pay tiny amounts in Q1, Q3, and catch up in Q4 without penalties. The catch? You have to file Form 22-10 Schedule AI with your tax return to prove you use this method correctly. It's more complex, but if your income swings wildly, it's worth it. Consider working with a CPA for this strategy. Let's talk payment methods. You've got 3 main options, and they're not all equal. Option 1. IRS Direct Pay. This is the easiest for most people. Go to irs.gov/directpay, enter your bank account info, select estimated tax and the tax year, and schedule your payment. You can schedule payments up to 365 days in advance. So on April 15th, you could schedule all 4 of your 2026 payments right then and there, and they'll auto-debit on the due dates. No fees. No account required. Maximum payment is $10 million, which covers pretty much everyone. The downside? You can only schedule 1 payment at a time through the interface. So you need to go through the process 4 times if you want to schedule all 4 quarterly payments in one sitting. It takes about 10 minutes total. Option 2. EFTPS, the Electronic Federal Tax Payment System. This used to be the gold standard. You enroll at EFTPS.gov, wait for a PIN to arrive in the mail, takes about a week, then you can schedule recurring payments. The benefit is you can set up all 4 payments in one session and track them easily. The catch? The IRS recently announced that individual taxpayers can no longer create new EFTPS accounts. If you already have an EFTPS account, you can keep using it. But if you're starting fresh, you're using Direct Pay or your IRS online account. Option 3. Mail check with Form 140 ES payment voucher. This is the old school method. You print the voucher, write a check, mail it by the due date. It works, but there's no confirmation, no tracking. And if the mail is slow, you might miss the deadline and get penalized. I don't recommend this unless you have no other option. Here's a mistake I see constantly. People think safe harbor means they won't owe anything when they file. That's wrong. Safe harbor protects you from the underpayment penalty, but you still owe the tax. If you pay $15,000 in estimated payments using 100% safe harbor, but your actual 2026 tax is $25,000, you owe $10,000 when you file, plus interest on that balance from the due date of each quarterly payment. The interest is much smaller than the underpayment penalty, but it's not zero. So if you know your income is jumping significantly, consider paying more than the safe harbor amount to reduce your balance due in April. You're not required to, but it helps with cash flow and avoids a big tax bill surprise. Let's say you miss the June payment. What happens? You'll likely owe an underpayment penalty for that quarter unless you catch up. The IRS calculates penalties quarter by quarter. If you paid on time for Q1, Q3, and Q4, but missed Q2, you'll only owe a penalty for Q2. The penalty is based on the federal short-term interest rate plus 3 percentage points, compounded daily. It's not huge, but it adds up. For 2024-2025, the rate has been around 8%. So if you underpaid by $3,000 for one quarter, you might owe $50 in penalties depending on how late you catch up. If you realize you missed a deadline, make the payment as soon as possible. The penalty stops accruing once you pay. Here's what you need to do right now. First, pull up your 2025 tax return when you file it by April 15th, 2026. Look at line 24, total tax. That's your starting number. Second, check if your 2025 AGI on line 11 is over $150,000. If yes, multiply your total tax by 110%. If no, use 100%. Third, divide that number by 4. That's your quarterly payment amount. Fourth, go to irs.gov/directpay and schedule your 4 payments right now. April 15th, June 16th, September 15th, and January 15th, 2027. Set it and forget it. Fifth, track your 2026 income monthly. If you're making significantly more than 2025, consider increasing your estimated payments mid-year to avoid a massive balance due in April 2027. Estimated taxes don't have to be stressful. Use the safe harbor rule, 100% or 110% of your prior year tax divided by 4. Schedule your payments through IRS Direct Pay on the 4 due dates. You'll avoid penalties, you'll stay compliant, and you'll have predictable cash flow. Don't overthink it. Don't underpay and hope for the best. The safe harbor formula is your friend. Use it, set it, and get back to running your business. If this video helped, hit subscribe for more freelancer tax strategies every week. Drop a comment if you have questions about estimated payments. I'll see you in the next one.